Hi everyone, welcome back to the HFAC comp. In our last video, we looked at comps analysis, how to use comparables analysis or comps analysis to figure out the value of a company based on other comp companies, comparable companies, companies in the peer set in the universe of similar companies. So maybe if we're looking at Apple, we can try to compare it with other tech companies to try to figure out how much it's valued in relation to those. That is a relative form of valuations. We're trying to figure out how much a company should be worth based on its peers. Now, I want to move into our second valuation method. This is our key valuation method and the last major concept we're going to teach in the HFAC comp, which is the DCF, or the discount cash flow valuation. Now, unlike comps analysis, which is a relative valuation method, this is a fundamental valuation method. It doesn't rely on other companies. Instead, we're going to look at the company's finances that we're trying to project. We're going to project out those finances, the financial statements in the future. We're going to think about what the revenues will be 1, 2, 3, 4, 5 years from now. And then we're going to use all that information that we project out to come up with actually a valuation of how much we pay today for a company. But before we can get into figuring out the revenues in the future in what we call the RPM or revenue projection model, we need to figure out some key things that make a DCF work. Now, we want to talk about some key building blocks. And the big thing in a discounted cash flow valuation is discounting. So I want to start with a question. You've probably seen this question if you've taken Act 10 or any other Act class at Harvard or anywhere else. So is a $100 bill worth more today or in the future? So pause the video for a second and think about the answer to that. So welcome back. The answer to this is quite interesting. It's worth more today. And the question is why? Well, we could have received a return or interest on the $100 by investing it somewhere else. So maybe I get $100 today and I go put it in my savings account and I make a very small amount of interest. But in a few years from now, I'll have more money than I had now, technically, on a nominal basis. So for those who've taken Act 10, this is the idea of an opportunity cost. The opportunity cost of non-investing it is going to be that percentage interest rate there. So we can look at this by example. So let's suppose that I have $100 today and I earn 3% annual interest. What is that future value of $100 in 1 year and 2 years? So how much will I have in 1 year and 2 years, right? And we have an interest rate here. So you can very easily just go and calculate the first year. That's pretty easy. It's 1 plus the 3% interest that you're going to make. So in the end, that's going to be $3 worth of interest. So that's going to be $103. And then in your second year, remember, you're going to do the $103, and then you're going to find the 3% of that and add it to the 103. So we can look at the math here, right? So the future value is equal to the principal times 1 plus IT. This is a compound interest formula where you apply the interest on an annual basis. And this interest rate, you might often see it's called the discount rate. And we'll come back to that concept a little later. Now, let's flip the question a little bit. What if we have the future value and want to find the present value? And we can think about this in the concept of stocks. If we can figure out the future price of a stock, we can figure out how much we should pay now based on that discounting concept. So we can just flip our equation around and we see the future value is equal to the present value times 1 plus IT. So that's what we started with previously. We flip it around and you get future value over 1 plus IT. So if you received $110 in 1 year, what would it be worth today? Assuming again that 3% interest or discount rate, it's going to be worth $106.80 today. Now, this is a very common concept in finance. You will see this whether you're going into quant finance, if you're pricing options or futures. This concept of discounting is very important. So we really find it's important in HFAC to really pause and just make sure you fundamentally understand the concept of discounting and this future value formula. Remember, future value is equal to the present value times 1 plus I to the t. You might see different variations, but make sure you understand the concept of the present value, the future value, and why they're different. But this pauses the question, right? So in this question, we saw, okay, if we get $110 1 year from now, there's a 3% interest rate, how much do we pay today? So what is that percentage discount rate that we need to use for a stock? So what is the required rate of return for an investment to make it valid? So we like to say that a company generates an excess return if they generate a return greater than the cost of capital. The cost of capital represents how much does it take to fund the business, either via equity or debt. Remember, we saw that there are two ways in our accounting unit that you can get money for your business if you want to grow and expand, other than making revenue, obviously. You can go out and sell stock. You can sell pieces of your company as equity. That's what we see when you do IPOs, follow-on adding, secondary offerings, etc. Or you can take on debt, which is where you get a loan, you issue bonds, and then you will pay back that principal there, but you get a large amount of cash up front to, again, invest into the business. So this cost of capital comes in equity or debt. Now, to figure this out, we can just figure out the cost of equity, the cost of debt, and take a weighted average. And that's what we're going to do. So companies can receive capital from either debt or equity, and we'll use the weighted average cost of capital as simply a weighted average of the cost of debt and cost of equity. So the WACC is E plus D. E is the market value of the firm's equity. Note we use the market value of both the equity and debt, not the book value. And if for information that, refer back to the accounting units where we talked about the difference between market and book value. So you just take E over E plus D times the cost of equity, and then you do D over E plus D for the cost of debt. And now this is always very important. A lot of people get tripped up in this. It's not just a straightforward average. You also need to account for the tax rate, 1 minus TC. Remember, the reason that you have to account for the tax rate is because there's a tax shield when you take on debt. So that technically helps lower your cost of equity just a little bit over there. So that's why we always account for that tax shield there. So WACC reflects the riskiness of a firm. Investors will demand a higher return to reflect that increased risk. And we see this, right? If your cost of debt, which is effectively the interest rate on debt, and we're going to look at the formula for this in a few minutes, though. Think about it as the interest rate there. If you're a very risky company, you're going to have to demand a higher interest rate. So that WACC is going to be higher if it's a more risky company. So we can think about WACC as representing risk. And here we went into FactSet, which hopefully everyone has access to. If you don't, make sure you ask about it in the section, to look at the WACC between Apple, which is an established company, has been on the market for decades now, and Palantir, which actually just IPO'd a few months ago. So notice that the cost of equity for Apple is 6%, but the cost of equity for Palantir is 10%. Now, this is going to be a little odd because they're using this 3-year adjusted beta, and Palantir hasn't been on the market for 3 years. But we'll discuss how beta plays into this and how the cost of equity changes based on the business. And they take that, they multiply it by the weight of the equity, 94% in the case of Apple, 99% in the case of Palantir. Then they look at the after-tax cost of debt. So they take the cost of debt there, do 1 minus the tax rate, and then they multiply it by the weight of debt. As you notice, Palantir has a lot less debt. Probably, again, venture capital company coming from Silicon Valley. Those companies just tend to have less debt. So now let's talk about how we figure out the cost of equity and the cost of debt. So what is the cost of debt? The cost of debt is simply the interest across all forms of debt issued by a business. But remember, companies don't pay taxes on interest, so that's why we have to account for our tax shield. So the cost of debt is the after-tax cost of debt. All you'll do is take the overall interest expense of a company in a given year, and then you'll divide it by the total average debt that the company has, and multiply that by 1 minus the tax rate. So cost of debt is pretty straightforward, but cost of equity is a little more complicated. And we need to understand a few things here. So let's understand equity risk. We think about risk when you have a portfolio of stock. So let's think about a basket, maybe you hold 20 or 30 companies. Now, each stock will have some unsystematic risk. Maybe the company goes bankrupt, or the CEO, gets sick and has to resign, or something like that. Something that's very specific to the firm. You cannot model it. It's idiosyncratic. It's unsystematic risk. So you have that kind of risk. Now, the more companies you have, and just statistically, it's just less likely that risk is going to occur. So if you buy the S&P 500, even if one company has an issue in the S&P 500, that's only 1 out of 500 companies. The other companies hopefully will compensate for that idiosyncratic event for that specific firm there. But there is undiversifiable market risk, this systematic risk. So during the COVID crisis, when we saw markets fall, we saw that across all companies. It didn't matter if that company was even going to make money during the pandemic. It probably also fell a little bit. That's an undiversifiable market risk. So it doesn't matter if you own 1 stock or 1,000 stocks, your portfolio probably fell during that COVID crisis because that was a systematic market risk that you could not diversify away. So remember, if you hold one stock and that company goes bankrupt, you're going to lose all your money. But if you hold 100 stocks and just one of them goes bankrupt, you're still going to be doing pretty good because you've diversified away your unsystematic risk. Now, so we have this concept of risk, and we'll think about this in a moment here. Is there a return without risk? And in the United States, we tend to believe that the standard treasury rate, which is the amount of money that the government will pay in interest if you give them money. So when the government borrows money, they issue various products to do so. You have treasury bills, treasury notes, T-bills, T-notes, treasury bonds. They have 1 year, 3 year, 5 year, 10 year, 20 year, 30 plus year maturities. And they come, again, all kinds of products here. So this is a 1 year treasury rate. Again, if you've taken this should be very straightforward, right? Key thing during a recession is you want to lower interest rates. So the recessions here are highlighted in gray. You'll notice that interest rates have fallen. Right now, since around March, the Fed has been targeting interest rate, a federal funds rate. They're of anywhere zero lower bound, so 0% to 25 basis points. So right now, standing at around 0.11%. Again, if you have want more information on how that concept of interest rates work, I find it very fascinating. You can get that in many macro classes at Harvard. You can come to office hours and we can discuss it. So we have this concept of return without risk. So the cost of equity is going to be the risk-free rate, so which is representing no investment, right? If you invested in a riskless asset, you're going to get this guaranteed rate, plus this risk premium, which is the additional return required to compensate for an equity investment. And that risk premium, right, will come from that market risk. It's not going to be from that idiosyncratic risk. So we have to model out that market risk. And the question is, how do we do that? So we use something called the capital asset pricing model, which is built on modern portfolio theory. CAPM model attempts to determine a theoretical required rate of return for some risky asset. I, again, find this very fascinating. I really like these pricing models. There are all kinds of different ways that these models work. You have CAPM, you have another one called Fama French, the 3-factor, 5-factor models, but effectively they're all the same thing. They're looking at correlation. So the expected risk return for an equity, so RE, is going to be the risk-free rate plus some correlation, which we'll denote as beta, as the expected market return minus that risk-free rate. So remember, the risk-free rate represents holding cash or no investment, pretty much, or putting it in a riskless asset. We look at the sensitivity of the asset to the market's change of return. We figure out what that expected market return is, and we'll talk about how that's figured out in a moment here. And then we look at the premium required for investors to favor equity over risk-free assets, right? If equity assets are delivering something less than the risk-free asset, why would you put it in an equity asset? You would put it in something that's risk-free. So what is this beta? So the two things that we need to figure out here are the beta and the E of RFM, the expected market return. So what is beta? Beta is actually just a correlation. So if you actually go to a Bloomberg terminal and you try to find this, you'll actually notice that you'll get a correlation analysis like here. So this is literally a correlation between Apple's percentage returns and the S&P 500's percentage returns. And we see the raw beta for Apple is 1.01%. Or 1.01, not percent, just 1.01. It's a coefficient. Now, quick question to think about here is, why is the beta for Apple so close to 1? And I want everyone to pause the video and just think about that for a second there. So welcome back. So hopefully you thought about that. So why is Apple's beta so close to 1? Well, that's because Apple is one of the largest companies in the S&P 500. Tech companies and these very large mega caps, as we can almost call them now, make up a significant portion of the S&P. So when those companies move, they will dictate a lot of movement in the S&P's index there. So they will have very standard market betas because in some respects, they are the market. This is, again, an ongoing piece of research in quantitative finance and economics, is kind of understanding how that's changing. Again, if you look 20, 30 years ago, this was not the case when CAPM first came out. You would have a wider range of betas, just given because we haven't seen the domination in the market of very big caps and very small caps. If you want more information on that, I highly encourage you to take a look at the returns of SPY, which is the S&P 500 index fund. And you can look at RSP, which is an equal weighted S&P 500. So every company gets the same weight instead of the market cap weighting, which is what the S&P 500 index normally uses. But if you look at an equal weighted index, you'll notice some very interesting return differences when you see that, and it can really be interesting to look at if you look at it over the past few years. But again, if you want to discuss, feel free to come to office hours and we can chat about that. So we need to figure out this beta, but how do we figure out this beta? You could obviously go to a Bloomberg terminal and do it, but a lot of us work in Excel, so in finding correlations is hard. We can use some stat 110 magic, and if you actually look, you'll see that this stuff is in the textbook. You can find beta by taking the covariance of RE, which is the return of your asset, and the covariance of that and the market return divided by the variance of that. And you can see just a little Excel snapshot for S&P and Alaska Airlines, ALK. We look at the S&P percent there, and then we look at the ALK percent. And remember, this is the correlation of the daily percentage change, not of the underlying value. We need to normalize it somehow, so we're taking the correlation of the daily percentage change, not the underlying value. So here, we see the S&P percentage change, we see the ALK percentage change. Effectively, unlike that first day, S&P went down, Alaska went up, negative correlation there pretty much. But the other day, positive correlation, they both went down. The next day, they both went up. So again, standard correlation, we'll do this anywhere from 3 to 5 years. Again, the longer the better if you can try to find a very stable correlation there. So we figured out this concept of beta, right? So we've correlated to the market in the past. This is the past correlation that's existed. Now, what is that future market going to return? And if you can take that future market return, you can multiply it by your beta and figure out how much is that cost of equity going to be? What is that expected return going to be there? So the expected risk market premium is what is the return needed to get investors to buy stocks instead of risk-free? Okay, so this is a little harder to find. Normally, we calculate this based on historical data. Our recommendation, and a lot of people use this, is to turn to NYU Stern's Aswat Damodaran. He's the expert in a lot of these CAPM models in the implied premiums. So we tend to turn to him to do that. So you can see the implied equity risk premium on November 1st of this year is 5.35%. In the previous month, the equity risk premium is 5.29%. So we noticed it went up a little bit over there, and he notes that this is COVID-adjusted numbers there. So the question of things is, why did it go up a little bit November compared to September, or the previous month there, October? And before, I remember it from earlier in the year, it was like 5.7. It was much higher at the peak of the COVID economic crisis, the stock market fall. So the question is asked, why did it go up a little bit? Well, there seemed to be a little more uncertainty in the market, so investors are going to demand a little higher expected risk premium to account for that over there. So that's why we see that. It's actually very cool to take a look at the implied premium over a long period of time, and we notice that during the energy crisis, the tech bubble, and the great financial crisis, we notice that these implied equity risk premiums do spike up. So again, this is a very theoretical understanding here, but it's very interesting in my mind to look at over there. So remember, when people demand a higher return, the equity risk premium is going to go up. So let's recap everything that we've seen here in the weighted average cost of capital, which will become our discount rate. There are two components, the cost of equity and the cost of debt. The cost of equity is made up with the equity risk premium times the beta plus the risk-free rate. Remember, the equity risk premium you'll take the expected return on the market minus your risk-free rate. So that's going to give you your cost of equity. Next, you're going to take the cost of debt by taking the average yield on the debt. And the way we determined to find average yield was just to take your interest expense over your total average debt and multiply it by that tax shield, 1 minus the tax rate. That's going to give you your after-tax cost of debt. Now, after we do that, we just take a weighted average of the cost of equity and the cost of debt based on the amount of debt and equity that company has, and that gives us our weighted average cost of capital. So let's take a look here. So recap, right, on the formula. The WACC is here. So our F, actually let's start with the WACC. So E over E plus D, right? It's the percent that comes from equity, and D over E plus D is the percent that comes from debt. RE is the cost of equity. We use that. We find the CAPM model. What are the pieces that go into the CAPM model? RF is the treasury rate. The beta is your beta, and then the formula for that, remember, is the covariance between the expected return of the market and your asset divided by the variance of the market, or you can determine it with a Bloomberg terminal. That's the more fun way. And then you want to multiply that by the expected market return minus the risk-free rate, your implied equity risk premium over there, which you get from Damodaran. Note, when you get it from Damodaran, he's already subtracted out that risk-free rate. So you don't need to subtract the risk-free rate there. So that numbers that he's listed there, that 5.35, he's already extracted the risk-free rate there. So that's how we do that. Then for cost of debt, much easier. We take our interest expense and we divide it by the total average debt that the company has. And that's pretty much how you're going to find your WACC and your discount rate here. So now that we have this, in our next video, we're going to look at some modeling strategies on how you can figure out what the expected risk premium, or how to figure out what to project what a company is going to generate in revenues over the next several years. So we're going to look at that in our next video. We'll have to do some balance sheet modeling, and we'll model out a little bit of the cash flow statement over there, and we'll put it all together. What we're going to also be doing this semester is releasing a template. So remember that the case study company that you've been seeing in section is Lululemon. So we've actually built out a DCF for Lululemon. We had Simon build it out this week, and we'll be releasing that to everyone. So this will serve as a template. And hopefully for your company, so the stock pitch competition, we want you to actually use our template. In the past, we've had people try to build it from themselves, but that causes mistakes. So we've actually pre-filled a lot of these formulas and a lot of these numbers already for you. So use the template. It will have everything you need, but we're going to go over it next week. So until then, enjoy thinking about discounting and WACC, and we'll see you in our next video.